You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
And welcome to this pre-Christmas edition of the Option Block. If you're not hearing the deep, sultry voice of Mark Longo today, that's too bad, because unfortunately he is not here, and I have some big shoes to fill as the host for today, but I will do my best, and we'll try not to poke fun at Mark too much when he's not here, and then not have too much umbrage on it. But with that being said, speaking of umbrage, let's go out to the great state of Maine so I can introduce my partner in prosperity and goodwill and the force, Mr. Andrew Giovinazzi.
Oh, as I just cough on my big intro. Yeah, and it's cold and kind of snowy, and it's a little like the song "The Weather Outside Is Frightful" in Maine. It's a little wet, cold, and snowy, and just what I think my sister-in-law calls stain. A little bit of snow and a little bit of rain is kind of just a stain. It's not fun winter. It's kind of yucky winter. But other than that, things are moving along. Things are moving along.
That is good. But the option block is so delightful, and
and the is frightful.
That's right. You know, the good thing about Longo not being here, he always talks about coming to the dark side, his partners in crime. We're men of integrity. We're on the side of the force. We're not the dark side. We're the good guys. So that's the good thing about having us and Longo not here. Wouldn't you agree?
I think, it's a much brighter, happier show. It's not just the darkness show. It's the show of happiness and light in the stock market, which of course, when you remain at all-time highs for as long as we have, it's easy to be the keepers of all things happiness and light when we're at 2250 in the SPX.
Well, speaking of all things happiness and light, how's that for a good Longo transition? With today, I mean, there's not a ton of movement from start to finish, but we did get some nice little moves during the day, and the day traders in our audience, I imagine, would be pretty happy with what went on today, or pretty sad, assuming if they were on the wrong side of the trades. But there were some opportunities to scalp a few things during the day today, just looking at the daily chart. What were your thoughts on today, and what's going on with the VIX, too?
Well, there was kind of the biggest thing we had, so this morning we're looking at VIX. VIX is cheap. You're getting a little bid into the 3-day weekend, which is not normal. I think, again, that's usually where the troubles begin, are overseas. There has been a bailout package for one of the older Italian banks. What is it, Monte Paschi? And I guess they failed to raise capital, and so either the Italian government's going to bail them out or they're going to liquidate the bank. I don't know what to think. But it was enough to make the vol futures jumped a little bit bid-wise. And the VIX jumped a little bit. I was just looking at the major bank stocks. Goldman's down $1.32. JP Morgan's up a little bit. Bank of America. I think Bank of America is down 9 cents. So not really much happened there. So it was enough to make the VIX futures jump about 25, 30, 45 cents depending on the term. It made VIX jump a little bit, or the VXX and the vol products jump a little bit because the futures caught a bid. And we have a trade on that probably should be added to in our option pit in our chat room. But the overall, we're going to have some follow through out of this Italian bank thing. If there's no follow through out of the Italian bank thing, they're probably going to smack the futures and the VIX down a little bit tomorrow. So we'll see. It's another overnight European thing. I think that was the only thing really that shocked the vol. It's not even a vol shock, but it was definitely a lift. And there's not a lot elsewhere. Gold. I mean, the GLD is down 26 cents. GDX, the gold miners, down 2 cents. It's just not a lot of the euros. Up. It's unchanged on the day. There's not a lot. Not there, at least for now. There hasn't been a lot of reason to worry about certain things. But anytime you talk bank, anytime you talk about bank falling apart, can't raise enough money to deal with their non-performing loans that they've probably been sitting on for the last 6 or 7 or 8 years. Gosh knows how long. Because at least in the U.S., we disposed of all that stuff really quickly. They sold it, rectified it, did whatever they needed to do. Banks failed. TARP money got paid back, and the securities. But I think the way the EU seems to deal with them, it seems they take a long time to make a decision about this stuff, and normally it just makes things worse. So to the extent that they fix, recapitalize, or normalize the loss, however you want to call it, and we'll see what happens with the vol futures tomorrow. So already they're starting to drift back a little bit here toward the end of the day from the highs, but if it's kind of a panicky thing, we could see some panic into Christmas. Not a whole lot different than we did last year, actually. Although I'm never quite sure why that all came about. But with interest rates now going up, I'm talking to some friends on the floor still, where there's like a little bit of interest rate game going on right now, where I think some liquidity providers, they're looking for interest rates maybe to go a little higher than everybody thinks. So there's a couple, those interest rate shocks, while like only only a quarter of a point or half point, they tend to reverberate a little bit more than just the size. So we'll see what comes from that. But as of right now, we got a little pop in vol, but volatility's been going down steadily for the last 2 or 3 weeks. So the fact that you have an up day or 1 or 2 up days in what was been a long-term trend down is not totally surprising. So, but that's what we got, at least for today on December 22nd, just the day before we break off for our massive 3-day Christmas holiday.
Yes, sir. Yes, sir. And the other thing, just going into next week has always been the most dead week of the year in terms of, at least from my, 15 or so years in the business. And usually this week isn't really extremely exciting either. But what I thought was interesting today is that we didn't have a lot of movement from, if you look at from start to finish, like the S&P, for example, down 4 points, not a huge move. But during the day, the peak to trough movement, so to speak, we actually had, I'm just looking at this, in the high of the low of the day in the S&P 500, we actually had 17 points of movement throughout the day today. And so I think that's pretty interesting, to say the least, because during the day, there are opportunities to be had, without a doubt. But typically, unless you are a day trader, it's difficult to jump on those. So the one thing that I would say to our audience as well is that if you are willing to sit by the screen a little bit more, you may be able to get some fills on some things that you may not think that you would have been able to normally, or if you don't want to sit by the screen, then by all means, there's these things called limit orders that work really well. If done properly. The only thing that I really saw lighting up the tape in terms of movement on the screen, Andrew, did you see the Russell today? We actually had a somewhat move down in the Russell. I think we're down about 12.5 points on the Russell 2000. You get a chance to catch that?
I did look. We actually looked at a butterfly on the Russell because we priced one anyway. Very flat skew. So the butterfly is priced okay, about a 40-point fly in January. I do have a slight visceral problem with butterflies, but VIX is only 11.5. It's low. But there's volatility to be had in the Russell. That's where the vol is. It's not in the VIX, and it really isn't much in the Qs either. So the Russell's where the volatility is if one were inclined to sell index premium, which is kind of that's not a small. It's not a small thing by any stretch of the imagination. So I saw that and I thought, well, because the fly is a little short delta, which the short delta didn't bother. I kind of liked it a little bit just because we feel like we're sort of pushing against the ceiling a little bit as far as where the market's going until we have some new news. I think the November 8th rally has kind of run its course a little bit. So in order to get to that new Tosaw happy place, we need to have a little more. We need some more, good concrete stuff happening that's positive economically.
We do. I mean, I'd like to see the Dow hit the 20,000 by the end of the year, just for the purpose of just for the fun of it, by all means. But it seems like if you go on the financial media throughout the day today, or just in general, it seems like the countdown to 20,000, or the Dow is about to hit 20,000. Dow is retreating from the run to 20,000. It just seems like it's Dow 20,000 everywhere you look, whether it's CNBC, whether it's Bloomberg, whether it's Fox Business, whatever the case may be. With that, I think what's interesting to note is that when the Dow went from 5,000 to 10,000, it doubled. When the Dow went from 10,000 to 15,000, then that means it only went up 50%. When the Dow went from 15,000 to, say, 20,000, let's say that we're knocking at the door of it, but then let's say that we hit it, it's only up 33.33%. So as we get higher and as we hit these larger numbers, it does become less and less of a big deal. Now, Grant, there's the psychological aspect of the Dow hitting 20,000, but I have to say, I remember being in college when the Dow hit 10,000, and I just remember just telling, I was an aspiring young NFL prospect business student back at the time, but I remember the big deal it was when the Dow actually hit 10,000. I wasn't friends with some other business majors apparently or I wasn't by any other business majors when it happened. I was just by the football gang, and they're like, oh, I don't care, who cares? But I do remember just watching it, how big of a deal it was. Would you agree that this is just not near as big of a deal at the 20,000 level as it was back at the 10,000 level?
I agree, because I'm old enough to remember the Dow being 2,300.
Okay.
So, and I remember some floor traders at the time going, "This is really cheap, man." It was about 6 months before Gulf War I, and just everything was kind of saggy, and nobody knew what to do, and oil prices were going through the moon. Everybody was sad, and ultimately, you want to make money in the stock market, you have to be able to buy stocks when everybody's sad and grumpy. And lo and behold, we're almost 10 times that level right now. Hard to believe, but that's where it is. So at 10,000, yeah, because that was 4 times that number. What we crossed 10,000 in what, like 1990 something?
99.
Yep.
Yeah, 99. So, we hit 10,000.
And we're about to double again. So still. And in 1999, it was all-time highs, and everybody's like, it'll never get that high. It'll never be that high. This is crazy. And then, although it's 17 years later, you did get that high, so you had effectively a double from a really high price. So 20,000, and then when they do 25,000, it'll be up another 20%. So the numbers are getting bigger, but it's still, let's just say it's slightly exciting, but it's not super exciting. But it is a number, and there's that gravitational pull to the number.
For sure. And with that, let's use that same gravitational pull to go on to our next segment of this show, and that is the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
Well, welcome to the odd block, everybody. This is the section of our show where we look over some option positions that seem rather odd. And with that, our resident odd block expert, I'm going to turn it over to Andrew.
Well, we can, it's hard to do this segment without actually Longo, talking on it. I'm so used to him. Sort of pontificating on the odd block that I feel like
he makes good smart mouth comments too. I mean, these is big shoes to fill. I get it. It's for sure.
It's not totally easy, So anyway, well, let's see how I can do. Okay, so the first one is Globalstar.
Let's just claim umbrage against Longo just to be safe for this segment.
You know why? Because he's on vacation again. Okay, I want all of our listeners to count up all the times that Longo is in a sunny clime working hard. That's all he's always in a sunny clime working hard somewhere. How does he get away with that? How does one do that? How does one get his job, the Longo job? I guess we have to ask.
How he rolls.
So anyway, so let's go to Globalstar. This would be an Alex favorite. GSAT is the symbol. It was up 35 cents to $1.82. So mind you, up, what is that, a 20% jump in the underlying price?
Wow.
Yeah, right?
Yeah.
New.
Not a bad day.
And I covered some call buying in this earlier in the week. And now, so it's in the middle. It's a Globalstar provides satellite services, voice data, everything through a satellite, wireless communications, all that stuff, not served by terrestrial line. So it is a global satellite communication thing. Anyway, but at $1.82, and that's after the 35-cent jump. So not much is happening. However, there was not my favorite phrase, but it's a phrase I like. There was a flurry of activity on the Feb 2.5 calls. So for 20 and 20, between about 20 and 30 cents, they traded 22,000 calls total. And the action was just back and forth. 20, 30, 20, 30, 30, paid 30, 30, 30, then 20, and then Now I think they're at 20 cents for all you want. So for whatever reason, and also calls versus puts, I think the ratio was like 8-1 or 10-1. It was I don't even think a put traded, actually, to be honest. Because how do you trade a put in a $1.81 stock? Let's see, what was that? The overall number was 40,000 calls to 600 puts. So
Whoa!
1.5%. What is that?
That's quite the ratio.
98.5% to 1.5%. So, let's just say it wasn't a lot of puts trading.
To say the least.
Yeah, to say the least. So I don't know what the deal is with this. The stock is up from, it actually was less than $1 a week ago. And so it's made quite a run. I don't know what's changed in their fortunes or if they own bandwidth, but somebody wants it. It's had a huge rise. I think over last 2 years, I think it was $3 at the most. So, but a huge change of fortune and huge speculative action on the 2.5 calls for 20 cents. And like Alex would say, just go buy the stock. It's $1.81. Go buy 1,000 shares and whatever. See what happens if you want to get long it. So, but there is action on the 2.5 strike, massive. So I thought that was at least an interesting thing, and it was follow-up volume from some call buyers a day or two ago that we covered. So stock's actually gone from $1 to $1.40 to $1.80. It clipped $2 for a while today as well. So there's unusual call buying activity in a stock that's an option. Globalstar, how about that?
A stock that is an option. I love that. Yeah, this is some serious option premium here. This is one where you can't buy the stock on margin just because of the fact that it's under $5. It's so cheap, or at least I don't know of any broker that would allow you to do it. But in theory, let's say you put 90 cents out, you sell the $2 call. Let's say you get filled at midpoint for 60 cents. And so by doing that, you have the chance to make a 10% profit between now and July. I'm looking at July, by the way. And for a very minimal call, you can make 10% on the stock itself, and the call itself would pretty much cover your margin requirement or close to it. So that's some serious premium, folks. And if you're thinking about doing that, normally I know nothing about this stock, but if you're thinking about doing that, don't. That's kind of the sure way to, maybe you can if you want, if you have a smaller amount of money. But with that, it's typically the premium's very high for a reason. So I'll just leave it with that.
Right. I mean, the value of the July 2 put is offered 90 cents. That's I don't know what's
serious.
going on. But another thing, too, a lot lately, you've had all these stocks that are split, companies that are like on the bubble, going out of business or whatever, the dry shippers and stuff like that. And then there's sort of a squeeze in the underlying, and they just go shooting right up for purely mechanical reasons. So this is another one that it could possibly do that. There's nothing to stop the company from getting squeezed. So, I mean, I don't quite know why the stock is trading at such a low price, because it seems like it kind of has, some sales and things like that. But, it's just one of those things where I think at one point it was worth something, and now it ain't worth anything because the reality did not match the hype. So we'll see what happens. But 440 million shares outstanding for $1.81. So there's some float out there.
Wow.
Yeah. The next, I always try to find I always have to find a name for Longo, because he likes the symbol to be the same as the company. He enjoys that. So
yeah, he does, doesn't he?
He does like that. So I do look for him for those things. And you can't always find one, but this is a good one. This is Kors, Kors, for Michael Kors Holdings, the eponymous maker of handbags and women's clothing and all that kind of stuff. So that stock was down $1.30 today, $1.35 to $42.86. And, it's kind of been struggling. It's like sort of in the middle of the range, not quite catching the November 8 rally, so to speak. But now what I've seen in Kors, which I found odd lately, is somebody keeps rolling some calls down. It's almost like they bought calls and they keep rolling them down because nothing's really happening. So in this case, if we go out to the Jan ordinary cycle, it's the Jan 52.5 call. It was a 52.5 call spread traded for 20 cents, 10,000 times. There's huge open interest on the 52.5. So what I'm assuming is they rolled those, they bought those, I'm sorry, they sold those for a nickel, and then they bought the Jan 50 calls for 20 cents, or sorry, 25 cents. So they actually net paid 20 cents for the spread. So again, this is a head scratcher for me because that's the pricing looked like they had to pay for the spread. There's open interest on the 2.5s, so I'm assuming they closed those and bought the 50s. So the next thing is, why would you buy the 50 call in Michael Kors when the stock is trading 42.75? Like, what are you expecting out of the company?
Quite a bit.
I guess so. I mean, it was just trading 46. All right, I'll grant you that. It was even trading 50, which is probably what started this mess for this person in the first place, on the 8th. And it's been kind of a one-way trip to Palookaville ever since for the stock. I mean, it's down at least 20%. So I think maybe they bought these calls, and it's kind of just been a trail of sadness because it doesn't look like they're rolling a short, kind of buying in a short call down. They continue to, I mean, at least the way the options are priced, I can't imagine a liquidity provider paying 20 cents for that spread. I can see them selling it for 20 cents. I cannot see them buying it for 20 cents. So, yeah, because I had the midpoint value on the spread. Actually, where it was priced is more like 10 or 11 cents. So for 20 cents, I just figured liquidity providers got to be selling that because that's what they're in the business to do, sell stuff that's over expensive. And so I've seen another roll in here as well in Coors, actually from the 55 level down, I believe, earlier, like last week. So it's just more of, it's more of the same where they keep trying to get closer to the strike, trying to grab whatever they can from the strike they're long and looking for some kind of bump back up by, the end of the month, I guess. That's all I can see on that. So,
I would agree.
But that is a Longo special. There was a $1 stock for Alex, and now there's a same name symbol for Mark. And here is just a.
Did you do a stupid for me? I feel so left out.
I couldn't find any stupids. However, I do have a stock with the ticker name of Ego.
Ooh.
You gotta like that, right? EGO.
Gotta respect that.
Eldorado. This is kind of a Tosaw name because it is a miner of the shiny stuff. Gold. It is a gold miner. And the symbol's EGO. It's Eldorado Gold Corp. It's in the middle of the range. It was doing better when the miners were doing better, but now it's kind of off a bit. Somebody bought a bunch of the Jan 3 calls for 20 cents. Again, this is kind of the classic sort of buy right thing for premium. On this particular one, though, I think the customer is either closing. There's a lot of open interest on the 3, so they're either closing the calls, or they are, trying to buy more of the strike, looking for a bounce, into the beginning of the year for the miners. We'll see what happens with the open interest. I assume they're just probably trying to take some short calls off, and normally when you see that, you got the call riders taking their short calls off. They think the sell off is kind of done, and they're looking to reload for the upside. So it very much looks like that kind of a trade. So we have a gold miner sort of, I think, short covering. We have somebody rolling down in Coors, hoping that the stock gets back to where it came from. Kind of a hope against hope, but it could win. And we have a cage match at the 2.5 level on the mighty Globalstar. Just a bunch of goofy stuff. And all this goofy stuff, the total volume was about 50,000 contracts.
That's some serious goofiness.
It is some serious goofiness and the net price of all 3 stocks put together, or the gross price, would be about $46.
Wow.
Yeah. So a lot of contracts for not a lot of equity value there. Although Coors is a real company. And that's what I got for the odd block for probably the last Thursday of before Christmas. Actually, it is the last Thursday before Christmas.
Yeah, the high probability of that. And that concludes the odd block for today. And now we will move into the strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the strategy block.
And welcome to the strategy block, everybody. My name is Mike Tosaw, as I told you at the top of the show, and I've probably told you at least 500 times. No exaggeration, because we've had 500 shows. And today, I want to do the strategy block. In the strategy block today, the theme of it is going to be, if you don't know synthetics, then you don't know options. Now, the thing that all of us in the options education world love to talk about are synthetics. It fascinates us. It's fun to talk about. It's very interesting to us, but most traders find it kind of boring in the retail trading world. From my experience, most don't seem to like it that much. But today I want to give you a real world example of something that I did and how it can relate to really having a knowledge and an understanding of synthetics. Now, I've talked to you on the show before about how sometimes I'll have to get out of a spread in an account that has less than $25,000 in it for a client, because I have some clients that have just a couple $1,000s, and I have some clients that have several $1 million, and all points in between. And so sometimes if you want to get out of a spread, then you can do what's called boxing it off, meaning the put spread goes against you right away. You can do a call spread to synthetically create a flat position, and you won't have a day trade put against you. So that's one example of how understanding synthetics can benefit you. But here's another example, and I really want you. And I'm going to give a basic example, and then I'm going to give the example of what I did today. Let's say that there's not a debate, but there's a conversation that always goes out, selling a put versus buying the stock and selling a call against it. Well, synthetically speaking, they're identical. Now, maybe one's priced a little bit better than the other for a certain period of time, but ultimately, net everything's the same. So, like I said, you might be able to get some type of advantage at certain points during the day, but good luck getting it. So my point is this. Let's say that you're in a covered call trade and you buy the stock at 50. You decide to go the covered call route for whatever reason. Buy the stock at 50 and you sell the 52 half covered call, and the stock goes down, and you know, because you listen to the boys over at the option pit, when you can get out of a short option, you do it. Meaning, if the option is at a nickel, it's foolish to wait another 3 weeks to let it expire worthless when you have that risk. Just buy it back for a nickel and move on. And so you decide to do that. You do the right thing with that. Now, let's say that instead of buying the stock and selling the 52 half covered call, you decide to just sell the 52 half put. And you know that you want to continue. You want the stock to get, if the stock goes down, you want it to get put to you, or meaning that you want to be in the stock. So you're cool if the stock goes down to like 48 or something like that, and you want to be in it. It's not like the stock's going way down and it's not past your stop loss point or anything like that. It just come down a little bit. You want to just kind of do the wheel trade, so to speak. Well, let's say it's down there at 48 and you sold the put, and you're thinking, well, if I would have done the covered call, I could have just bought to close that call, and then I could move on with this, and I could, maybe just be long the stock like I would, and just if the stock happens to go way up, then I'm going to miss out on it. I wish I would have just sold the covered call, because if I want to get out of this put, then I got to buy to close this put, buy the stock, and I just don't want all those commissions. It's just a giant hassle. Well, here's something that you can do if you are in that situation to where you sold a short put, and you're in a spot to where there's no time decay left in that put option, but you still want to have the upside, and you still would like to have the stock position, so to speak, until the end of this put expiration. Calls and puts are priced almost identical. And, there's some factors that are involved in the difference between calls and puts in terms of how, if there's a dividend in the stock, and there's a lot of little things on it, but for the most part, it's pretty darn close. So what I want to mention today is how, should that happen, you're in that situation to where, man, if I was in this covered call, I'm looking over at what the calls are priced at, I'd just buy to close that covered call for a nickel, and I'd be out of this, and I could just be long the stock and go along my merry way. Well, here's how you can be long the stock and go on your merry way. Instead of buying to close the covered call, if you're short the put, buy to open that same call. You might say, but Mike, I thought you're supposed to never buy those tiny options. Well, no, you don't have to buy those teeny options, but here's the reality of it. When the stock goes down and the put goes far in the money like that, you don't have a lot of time decay in that put anyway. So meaning if the stock stays still, you're only going to get another 5 pennies out of it anyway at best, let's say. So by buying that 52.5 call option to open, what that then does is you still have the same risk you would as if you own the stock, because you're short the put, you're obligated to buy the stock at 52.5. But by buying that call option, let's say that stock does go on a turn to the upside. If it goes up to 58, 59, 158, 159 for that matter, whatever the case may be, should that happen, it is the same thing as owning the stock. Now, there's tax differences and things like that, but from a pure risk-reward standpoint, there is no difference in it. So if you are in that position to where you're thinking, well, should I sell a put or should I just buy the stock and do a covered call? Still doesn't matter, because if you're concerned that, well, if the stock goes against me, I like the luxury of just buying a call, buying to close that call and just having it done. You still have that choice. Just simply buy to open that call. So by doing that, it's what's called a synthetic. Or by doing that, it means you have an understanding of synthetics. Now, today, for example, I started a position, and for those of my clients out there, there's a bunch more to it than what I'm saying, but a short put spread went against me. I managed the risk. I got out of a bunch of it pretty early, and when it was lower with the remains of it, I was thinking, you know what, if this was a call spread, I would just buy to close this where the short put is, because by doing that, it's just a couple of pennies, and I'm not really getting anything out of this from time decay, but I still have a bullish bias, at least for this trade anyway. So I wish I could do that, and I thought, let me think of some. I didn't really think this much like a dork in my head, but I thought, what's the synthetic way of doing this? So I bought the long call option. I bought to open the call, and that created a synthetic long call. Now, for those of my clients that are out there, the numbers don't exactly match up to what I am saying, because there's different ratios that are involved. I don't want to get into that in the strategy block, but that's the concept of what I did today. And if you have an understanding of synthetics, folks, it's very important, because number one, you need to have a basic understanding of what you trade. But number two, there are situations to where they can come in very handy. And today was one of those examples for me. And that is the strategy block pre-Christmas today, 2016.
Very nicely done. Very nicely done.
Thank you, sir. Thank you, sir. And with that, let's move on to the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
And welcome to the mail block, everybody. What we want to go through today is the question of the week to start with. Now, Longo, since he's on the dark side and talks about all these things about being on the dark side as partners in crime, he cheats. He knows all the results right as he says it. Mark did forward us the question of the week, but since we're honest men of integrity, we're on the side of the force, we don't get to see what actually the results are so far. So with that being said, I'm going to go ahead and read the question of the week, and Andrew, we're going to have to just do this honestly to see where everything is, because we don't know these things. We are men of integrity in terms of the option block. So the question of the week is major market indices are pushing record highs. Everyone has protection on the brain. How do you protect your portfolio? First choice, just move to cash/bonds. Second choice, protective at the money or out of the money put. Third choice, put spread or a ratio spread on the, or I'm sorry, put spread or ratio put spread. And fourth and final choice, collar or collar with kicker.
I would say, at least for me, I would say of these choices, I would say protective at the money or out of the money put, because just volatility is so low. And I'm going to say a put spread, though, is what our listeners will weigh in on when they actually vote, when they vote the poll. That's what I'm saying.
All right. Okay. For me, I wish that all of the above was one of the answers, to tell you the truth, because I'm looking at some of the things with which I'm doing for clients at this stage with different things. And for me, in a lot of cases, yeah, I think I have a little bit of all of these in one way, shape, or form across the asset classes. So, but if I had to pick one, you know, I think I'm with you on this one, Andrew, just because vol is cheap right now. If I had to pick one, I would do an at-the-money put, or kind of what I'm doing now, the synthetic of it, having less money exposed and buying long calls. So I'll say for me, protective or at-the-money puts. And then in terms of what the audience would say, you know, I'm thinking that with all the talk of what we've had about collars on this show, I'm going to say that the audience is doing a collar/collar with kicker. But we don't know what they're saying because of the fact that you know, we don't have the results. So we'll have to wait and see how that one goes. So with that, let's go ahead into our questions of the week. Or, I'm sorry, there are some of our listener questions. First one, this is a question from Yukoner. Hopefully I pronounced that right. His or her question is, are covered calls still a viable strategy in a 401k these days?
Well, sure. Why not? I think what mostly my biggest problem with writing calls is it drives me nuts when I have to keep rolling them up. So I'm a lot less. I write less calls than overstock, depending on what the particular stock is. But it's not sort of a every month I'm going to write a call. It's more of, you know, when's a good opportunity to sell one against stock. I'm okay more if I'm long call options, and then I write some calls against that because you got kind of the decay thing going. But with stock, I do a little less. But when the VIX is this low, you're not getting a lot for the call. And what I would almost do now is, you know, look at calls that are closer to the money, you know, and keep the duration short. So it's like, well, how much more upside do I have to January? And then you just write an at the money call and just take that return and then roll it up higher if you need to. So that's kind of how I would sort of switch gears a little bit when the ball gets lower.
Yeah, I think that makes sense. I mean, you know, well, the only argument to that is, let's say you're doing it in Globalstar. Maybe you have Globalstar as one of your 401k holdings, and you want to get some serious juice on that.
That's tough.
But with that, I don't know if Globalstar would probably be the best holding for your 401k in your retirement account. So, but no, I would agree with you on that, Andrew. I mean, typically, excuse me, it is very frustrating to where if all of a sudden the stock goes up 6% and you're up net maybe 0.5% because you wrote that call option and the stock went way up. But if you're satisfied with that, if you're happy with that, then that's fine. And if you are going to be a covered call writer, whether it's in a 401k or in a non-qualified account, whatever the case may be, you have to be satisfied that you're giving up your upside, you're giving up potential for guaranteed premium. And by guaranteed, of course, you do have the risk of the stock, so there is still a risk in that, but the premium's yours to keep no matter what. You just have that downside risk when owning the call option. All right, next one is from Taz1. Do I have a broker recommendation for someone who is new to options, maybe with a cash account, since I don't want to do margin? Well, with that, Andrew, I know that probably the most popular broker, and this is the one that we use at RCM primarily, is TD Ameritrade for retail traders. We use the institutional Think Pipes platform. We don't use the Thinkorswim platform, and we do for helping people execute some portfolio margin trades, but for the most part, we're on the institutional Think Pipes platform. We also work with interactive brokers. I think that if you're a beginning trader, I think that would be an awful choice, quite frankly. If you are like a hedge fund and you need certain things, certain tools for certain situations, then interactive brokers could be a fit for you, but primarily TD Ameritrade with the Thinkorswim platform is probably the go-to platform for a lot of retail traders. At RCM, we also work with a company called Trading Block, and they're also work pretty well on the retail side of it. So with that, I think it's whatever fits you best, but I would say that TD Ameritrade is probably a good place to start and see if it fits you with what you're looking to do. Do you have any thoughts on that, Andrew?
Yeah, we like LiveVol, interactive brokers, Thinkorswim. All of those are good. And depends on what I think each platform's a little better at doing something. Like I think LiveVol is a better vol platform. Thinkorswim has really dynamic charts. IB is kind of the more people like the way the margining system works and things like that. So it's all a little different. It just depends on what you want. All of them will allow, have no problem with you just trading options with cash. So it's never a problem for a retail, an online broker to just, do cash account stuff. That's kind of there. They'll be happy to do that. But you really have to decide the kind of things you want to look at for whatever analysis you want to do. And that's, at least that's how I look at it. Or when clients ask us, what we look at in a broker, that's pretty much, it's the type of information you want. I think some brokers do some things better than others. So that's ultimately how that goes down for me.
I would agree. And that concludes the listener mail block for today. And now we're going to move into Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
And Andrew, on this last Around the Block before the Christmas holiday, what are you watching for tomorrow and possibly going into the next week that typically is not much of a market-moving week?
It's not, but it's also very illiquid week. So, is this Italian bank thing going to have some legs? Is it enough to move the vol? It definitely moved the vol futures today a little bit, but again, it's coming from just a low place. So, I mean, it makes sense that almost, anything that's hasn't, kept with the rosy script that we've seen will move volatility futures higher. The question is, can that stuff stick around? Other than that, I don't think there's a whole lot. I don't think there's a whole lot really to, we got a lot to look forward to, but I just don't think there's a lot going on here at the end of the year. But again, overnight news could change anything. But as of right now, I'm still looking at some VIX futures to decay a whole bunch.
I hear ya. And that music that you're now not hearing is a sign that we are at the end of our show. It has been fun, Andrew. We didn't poke as much fun at Longo as we should have, I guess. But I do want to say this on a serious note: the best source for options information on the entire internet, folks, is the Options Insider. They do a great. Mark's built up a phenomenal source of information. I always say I think the best way to do it is you can go to the mothership. You can go to theoptionsinsider.com, or you can do what I do on my phone. I download the Options Insider Radio Network app. That's how most of the ways with which I look at it. You can see the shows. You can just click on a button on your phone. They do a great job with that, and I can't say enough good things about the Options Insider Radio Network. But with that, say some good things about the Option Pit, Mark. Or I'm sorry, Andrew. What do you guys got going on?
We will be launching our vol course in January. If you want to understand how volatility works and then how the vol products work, that is that's what will be going on starting like January 17th. It's a great way to learn how the products work, and we actually show you real examples, how to price things, what to expect, and actually looking at realistic expectation for a potential trade. Instead of just saying VIX is too low, I'm just going to buy VIX calls. You actually understand how difficult to trade that actually is, and you look at much better risk ways that have much better risk reward profiles that will help you actually do the stuff you want to do. Try to get some juice for free, and all that kind of stuff that we try to encourage here on a weekly basis, or a daily basis at Option Pit, but bi-weekly basis in the option block.
For sure. And if you have any questions on working with a financial advisor, one who does not cower when he hears the term implied volatility, feel free to contact me. I'm more than happy to work with you. I work with people with as small of accounts as a few $100 and with as large of accounts of several $1 million and any points in between. My number is 312-212-3531, or shoot me an email at mtosaw@rcmfs.com. Well, that concludes today's show, everybody. We'd like to thank you for listening, wish everybody well, and we like to wish everybody a Merry Christmas. Thank you, everybody, and have a great day. Bye-bye.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.